if we kind of take a step back and say, all right, NVIDIA, clearly there's a lot of valuation here that shouldn't be baked in, that has been multiple expansion. If you just strip that out, does the rest of the market make sense to you, where we are with everything else?
Well, I mean, like I said earlier, the market makes perfect sense. It's paying up for quality, and it's paying up for growth that is, idiosyncratic from the economy, and maybe some defensive properties. Okay, great. So I think the market totally makes sense. The question is, are those multiples now in those particular stocks too high? I think if you get a perfect, soft landing in this plane, it could be fine. If you get any aberration from that, it's going to be a problem. And that's why we wrote about it this week, which is there's these three risks. Could inflation pick up again? Could there be a term premium spike because of the fiscal unsustainability? Or could there be a growth slowdown? Of the three doors, to put it in Monty Hall terms, I'd take door 3 as the highest risk today. Okay, that could change. And this is another lesson from the last year and a half. I mean, how many times have we changed the narrative in the last 18 months? We've gone from hard landing, soft landing, no landing. I mean, it's like, musical chairs. So right now it's soft landing. Great. As long as that remains stable, we can kind of stay in this sort of environment that we're in. But we have to be, as macro investors and traders, we have to understand these are the risks.
But there's an irony in it, which you already pointed out, is that underneath the surface, you are getting these big moves in stocks. You talked about going from one side of the boat to the other. The other way it's expressed that stocks is just correlation has broken down between individual stocks. And it's not even just an AI thing, because within sectors, stocks are no longer correlated. Is that a troubling turn? Is it a problem that that's happening? Do we need to completely rethink how we judge sectors and how stocks should be moving together?
Well, it definitely affects the latter part of your comment, meaning the idea that you're going to trade sectors is out. Okay, that's not working. So that relative value trade, which is what we kind of made our career, trading relative value in sectors, is not working really well. What's working is factor trading, which is why we're going back to things like quality, defensiveness, large cap over small. That's working really well. Operational efficiency. These are the factors that are working, which is more idiosyncratic. By the way, the breadth in the market today on a 1-month rolling basis is the lowest we've seen since 1965. Okay, that's even older than me. I mean, that's old. So, I mean, that's a long time. It doesn't mean it's necessarily the end of the world. We have many examples where breadth got really narrow and then it broadened out again. But typically, it requires some sort of a regime shift. Right? In other words, if we stay in the soft landing narrative, nothing's going to change. If we move to a higher growth, higher inflation, it's definitely going to shift probably more towards cyclicals. If we go into a growth scare or even recession fear again, that's going to be a rotation into defensiveness. So, we're open for anything because that's our job. We have to be prepared for that.